Andy again from Finding Value Finance. We're going to hit up Twitter again. Not really too much other things to talk about. I mean, I go over a lot of charts. Charts don't really change that fast. I'm not a day trader, kind of just holding on for the long haul. So the charts don't move that quickly where it really nullifies anything in days times. Usually it takes weeks or months, sometimes even years. So we're going to hit up Twitter, see what's going on there, what people are sharing, news, sentiment, talk about commodities, talk about wealth building, all those different things, and interject my financial opinions all across it. So let's dive in. Let's see what's going on, and we can go through it together. It's at finding_finance if you want to follow me, or you can join our community at finding-value.com, where I talk about individual companies, potential strategies that I am deploying, and how I'm playing this commodity bull market that we are in right now. So, inflation data according to Trueflation. He says, I definitely don't feel like my overall cost of living has gone down since last year. If anything, it has gone up. Anyone else? Well, he's showing a chart, and inflation is measured in percent growth. So the growth of the percentage is going down, but your cost of living won't actually go down. It's going to still go up at over 2%. So I don't know if he's misinterpreting this data. And this is what I mean by people who misinterpret the data. They don't know what they're looking at. Inflation isn't going like you're not your index. If this was an index, your index isn't going down. Your rate of increase is declining. So the increase isn't as much as it was back in August of last year. So I wanted to touch on that. They're kind of messing this up, reading it. I wanted to touch on this one. This was interesting. All right, and I talked about it, but I didn't really have a ton of data. And now here's some data on it. Benchmark VLCC route TD3C, Eastern Gulf to China is 20.6 days. With less Saudi barrels on the market, Asia will source incremental cargoes from west of Suez. West Africa's 33.8, Brazil's 38.3, and US Gulf is 53.1. Those are all much higher days to, we'll call it shipping days, to get the same outcome. So utilization go burr. Longer distances amid OPEC plus cuts to support rates. So rates will be supported. Brazil's 9.2% crude export tax expires when Saudi Arabia 1 million barrel per day cuts begin. And oil tankers and all this stuff, we could see good day rates and stronger utilization numbers with this increased distance. And that was something I think can still go up over time because if OPEC, let's say OPEC kind of flatlines in production, and a lot of the growth comes from Brazil, that's a longer distance to travel, which means some of these oil tankers, especially ones that have a lot of tankers that are going to be used worldwide, they're probably going to see better profitability, better efficiency, well, not efficiency, but better utilization. So something to think about. Here's one. A lot of the tweets for doomsayers the last 24 months ended with this line. Few understand this. And nothing they said ever happened. A lot of people are making predictions that haven't come true. They said inversion of the yield curve, higher interest rates, the whole thing collapses. But you know what? It hasn't collapsed. And they continue to say it over and over, making predictions. And maybe the curve inverts even more. I don't know. Maybe we go another couple years with the curve inverted. Maybe not. but I know a lot of people have made a lot of different predictions, housing market crash predictions, stock market crash predictions. I still think the stock market will roll over. I think that we could potentially do a double top. We could even go higher than the last all-time high. I don't think we're at the beginning of a gigantic boom. If for me to think that we're at the beginning of a gigantic boom in the in the stock market, is that the real estate market would go into a recovery phase. I don't think that's going to happen. If we were to get a crash in the stock market and things were to we get a recession, let's say, I don't think the housing market is going to get blown out to the downside. I think it will just go sideways. And then when interest rates come back down, and that's what happens during a recession, they usually put interest rates back down. I think the housing market's going to take off again, just like it did in the early 2000s. This time, I think there's a larger imbalance in the housing market, and I think it would be a bigger boom than even the mid 2000s. That's my take. Now, here is housing affordability. This is what the doomers always bring up. It says from 1979 to 1985, housing affordability in the US was not only as bad as it is now, it was actually even worse. This is the percent of a median family's gross monthly income that is needed to pay the mortgage on a medium home. Now sitting at 37% of monthly gross income for new mortgages. So it looks like it reached up over 50%, which is actually quite a bit higher than the 37% that we're at today. And that was late 70s, early 1980s that it was higher. The House Poor Index, monthly mortgage payment as a percent of median family income. We've got the Bund curve. Hasn't been this inverted in decades. Recession, stagflation. So, do you guys think we're going to have a recession? We could, yes. And the data supports that. Keep in mind, these yield curves invert when you have a highly inflationary environment. I don't know what they look like when you go into hyperinflation. I don't know if they just continually invert forever and then just go to zero. Like not go to zero, but they go away because eventually your currency will go away if you go into hyperinflation, I would assume. And this inverts and the yields will continue to go up and up and up and up and up and up in an uncontrollable fashion at some point, which means the yield curve inverts until you basically your currency goes away, right? I don't know. I don't know that much about hyperinflation and what the yield curve looks like in a hyperinflation. Let me know what you guys' opinions are in the comment section. But I would assume that's what would happen if the inflation continually gets worse. Basically, people flee the bond market. And when they flee the bond market, I would think that the yield curve continues to invert. The entire world uranium market is only 790 million. Yet it's enough fuel to produce nearly 5 times as much energy as humanity consumes every year. So how big is the oil market? We got the oil market at 2.1 trillion, iron ore at 283, gold 196 billion, copper, aluminum, nickel, zinc, silver, molybdenum, palladium, and lead. No platinum on this one because it's too small. A lot of small little commodity markets out there. Even crude at 2.1 trillion is basically nothing compared to some of these bond markets that are just gigantic. Market Sniper says they ain't tightening. Shadow Stats, money supply June 27th. The headline seasonally adjusted May 2023. U.S. money supply showed monthly increases both in the aggregate M2 and its most liquid component, basic M1, currency plus demand deposits. The ongoing flight to liquidity remained in play, with systemic liquidity continuing at a 34-year peak level, consistent with further inflation pressures. The latest unadjusted weekly monetary base reporting through June 28th suggested further easing continued in June. So they're not tightening, they are easing. more inflation. Still looks like 2000 analog playing out for crude oil. So we go in here. Here's your 2000 break, the retest in 2002, and boom. Here's your break, the retest in 2002, boom. Massive volume support base right underneath us. I don't think we're going to crash some gigantic move lower. Obviously, an opinion. We've got 2022 onward rising 6-year moving average, just like 2000, 6-year moving average coming back up. So here we go. Is oil going to take off here? Well, let's hope so. JC says this is a game changing catalyst for gold and silver. Precious metals could be instantly revalued in the weeks ahead. Standard Chartered is in trouble with its massive silver short position. So the BRICS countries are planning to introduce a new trading currency which will be backed by gold. More and more countries recently expressed desire to join the BRICS. Now, I don't know if this is going to be an instant revaluation. I don't I don't I don't put much into it. That's the current news that's being transferred around and shared. I think gold's going to go up when oil or energy has a problem and people start questioning the currency just like the 1970s. But it happens worldwide. I think this is the beginning of this, but when people line up and they run with a lot of money at the precious metal sector, that's when it's going to boom. It's going to start slow. It's going to be boring. Uh, Gold and silver is not going to do much. They're kind of just going to slowly melt up until the acceleration picks up. Then when things start to accelerate, people become more afraid. They notice that there's a problem, and then a whole bunch of money runs at it. That's my guess of how it's all going to play out. So here's medium net worth by age. You guys can compare yourself with this and see where you're at. Medium for 35 and under is 76,000. 35 to 44 is 91,000. 45 to 54 is 168. 213, 266, and 254,075 and up. Are you above or below that line? Well, at 91,000, I am above that line by a very good margin. Very, very good margin. You could probably multiply it by 10 or 20 times. COBE, is July the month for, so CBOE is global markets. And what do we have here? This looks like a, yep, cup and handle. Cup and handle ready to break to the upside. That's what I'm seeing. RSI is moving up. Looks pretty good. Looks pretty good. Commercial flights have reached all-time high. 7-day average above 2019, 4.2%, above 2022, 22% roughly. So number of commercial flights tracked by Flight Trader is up. And we're up by that amount over the last couple of years. It says one hell of a candlestick on Forces Metals Friday. I've been burned so long in this one, and it is hard to get optimistic over one candle. But if I could, that would be the candle. So we have a pretty large bullish candlestick on the right-hand side there. We've been moving sideways. What I see in this chart is that we could see a turn to the upside. We get large buying pressure candlesticks, small sell-off leak of sellers. Big bullish candlestick here, small leak down back. Another big bullish candlestick. That's generally what happens before a potential move to the upside. And that's what I look for. Volume starts to kick up as well. We don't see the volume kicking up as much, but it's got the traits. I'll say that. Here's the CRB index. It may rhyme. So we look at the last bull market, 220%, 190% peak, 227%, minus 76, minus 80 is this pullback here. And maybe we get another 190 up to the top there. And what I think is the potential here, this could very well be the potential move in the CRB index. We get one big old move out of this thing. We're all waiting for that move. We're all waiting for it. It says the unemployment rate moves significantly higher following yield curve inversions. Today's yield curve is the most inverted since 1989, indicating the labor market will likely weaken in the coming months. Well, I think people need to understand why. Why does the yield curve invert? Why do we get unemployment and all of those things? So, a lot of these here, like this one here and this one here, is from the housing market. Unemployment from the housing market is not going down. We are continuing to add jobs. Construction employment continues to go up. So I don't think it's from that. But we could get one that is like the 2000s, where the tech sector and a lot of those other sectors do have layoffs and have unemployment. So that is a possibility. It's just not the main driver of recessions in history. The main driver has been from the housing market. I don't think it's coming from the housing market. So you're taking a much less percent probability bet if you're betting that unemployment's going to drastically go up. It's going to be based off like a technology bust type move, I think. Here's one that says because there are two separate economies, both getting ready to hit the energy cliff. Tim Morgan of Surplus Energy Economics describes this in his chart. It's the real economy versus the financial economy. Finance and debt have masqueraded as assets to hoodwink the investing public. It says the two economies disequilibrium and exposure. So we've got the financial economy GDP going up, and then we've got the real economy prosperity starting to roll over and go down. This is what I talk about in that kind of higher inflation world. The financial economy, they're going to continue to pump money into the system. The real economy is not going to be able to keep up because you don't have the energy to support the real economy. So you get a divergence between money creation and credit versus real things in the world. And that's why I think we're going to see real things become more valuable. The things that have intrinsic value are going to become incredibly valuable because the money in the system is going to continue to go up, and we're not going to have the accompanying real items in the world to go up with it. So this is debt, and this is financial assets, and they're growing at different paces. Prosperity is basically this little blue line down there. It says what baffles me is why do infinite things like paper money and digits floating in the air price these finite things such as oil, gold, and silver? Yep. Agree there. It says what have we said many times before? Time in the market is better than timing the market. Market timers blow it again, embracing bonds on eve of AI-driven stock rally. Nuveen recommends investors dip a toe into certain areas. Assets in money market mutual funds rose to a record in June. I just find what I think's the market conditions that provide a tailwind, and then I look for undervalued assets. I stick in the undervalued assets and just sit in them. I'm not timing the necessary market. I've got all of the tailwinds at my back because the valuations are so cheap. So that's my approach, and I try to incorporate as much of that from Peter Lynch, Warren Buffett, and those types of investors. So here's Bob Elliott. He says the problem for Fed is nominal wages are growing at 5 or 6%, which is sustainably financing nominal spending at 5 or 6% for an economy with productivity growth near zero. Until there is a decline in wage growth relative to productivity growth, inflation will remain a problem. So compensation of employees received, wage and salary, and then personal consumption expenditures are very closely linked. So that's where I'm going to end it, guys. That's what we're seeing in the markets today. And if you guys like the content, give me a thumbs up, subscribe to the channel. I know some people hate my empty room. I don't know. I just don't feel like buying a bunch of furniture at the moment. When you have young kids, they just destroy everything. So if you don't buy anything, they can't destroy it. But eventually, I will put stuff back there. Maybe I put one couch. How about that? Or one couch and something to put something in a bookcase, or I don't know, something like that. But that's what I've got for today. We'll catch you guys later. This is Finding Value.